when it comes to understanding things about the stock market, trust me, I understand it. It gets confusing quickly and often. I feel like VTI is a really good, simple way to understand the stock market and a simple way to invest. There's so many different ETFs. You could look at dividend ETFs, at growth ETFs, at value ETFs, at high yield ETFs. There's so many different ones. VTI is just simply, it is the stock market. It's just the weighted stock market, all the different companies. You own a little sliver of each one. You don't own super leverage into any specific one of them. It's just simple ETF investing. Now, of course, you're going to be weighted towards the larger companies. So something like Apple is going to make up a much larger percentage of the pie than a super small company like Fabrinet. That's just one off the top of my head, right? So Apple's like 3 trillion. That company's like 10 billion market cap, which is just the size, the value of the company. So you're going to be weighted towards the larger players, but that's not really bad because the large players generally have performed better. And like I said, we're just buying the stock market itself. We're owning one little sliver, each company individually, in this specific ETF, and it performs well. In the last 5 years, you're up 84%. So that's just pre-COVID. If you zoom out a little bit more, since late 2001, when this ETF started, you're up 441%. I think that doesn't include dividend yield, but let's just say it is. 440%, that is very good performance. That's 24 years now. You're up 440%. That is great. That is awesome. And most of you are going to have a large percentage of your wealth either in your home equity or your 401k. Most people do. Some people maybe have a small business or a business they have a lot of their money in, but most people, it's just 401k and stuff like that. So VTI, like I said, it's a good, stable ETF. You can get maybe a little bit higher percentage long-term performance in something like a growth stock or S&P 500, maybe a little bit ticks higher, but VTI, there's nothing inherently wrong with it. If you understand it better, like why do we have to wait towards these specific stocks, or I don't trust that. VTI, it is the stock market. If the stock market's going up, VTI will go up because that's what it is. So it's good, really big diversification. We can see the performance Morningstar rates it. I agree with almost all of this except for this. So you get like a rating 3, 3, 3, 3 for the last 3, 5, 10 years. You get a little bit, better than average historical return, but a little bit above average risk. I would actually disagree. I'd say it's more in the middle for both because it literally, like I said, is the stock market. I don't really think there's more inherent risk in that. They're probably thinking more towards value stocks, but I think if you're holding certainly in the long term, if you have 10 plus years of retirement, you don't have to worry at all. If you're getting, maybe 5, 6, 7 years out, you should maybe start moving some more money to bonds or maybe more value if that's what you're looking for. But in a 10-year time horizon, you have almost absolutely nothing to worry about. It's always scary when stock market starts going down, but there's really nothing to be too scared of here. We can see how it's weighted. So there's the 3 largest companies, Apple, Nvidia, Microsoft, are above 5% of the assets. And then there's plenty more names you probably know. Tesla, Amazon, Meta, companies like that. And there's nothing that wrong with that, except if you just really wanted to not be too much in any stocks. But even if you weighted everything completely even, I'm just telling you, if those first 10 that you're mostly in start going down, the entire stock market itself just is going to. But there's nothing inherently wrong. You're okay. There's a little bit less tech in this. You're about 29%. S&P 500's maybe closer to 35, 39-ish, 35, 40. But it's really nothing crazy. You get financials, consumer discretionary, healthcare, industrials, communications. The only thing you don't really get a whole lot of: consumer staples, energy, real estate, utilities, materials. So most of these value-oriented stocks, so maybe more on that end. You're not getting quite as many as those, but generally those don't go up as much long term. Tech has been absolutely dominating the last 20 years. That's just the reality. So you want to have a lot of tech. You just do. I think I've covered most of what I want to. VTI, it's good. It's simple. You don't have to worry about all these specific, this ETF, that ETF, this just is the stock market. I would not have any concerns about a large percentage of my 401k being in this. I like growth and I like S&P 500. I have some of those ETFs in my 401k. However, there's nothing really inherently wrong with it. Certainly if you understand it better, you're going to do absolutely fine on it. It's certainly better to hold than no tech at all, no ETFs or stocks at all long term. I appreciate all of you for watching. If you enjoyed, appreciate if you left a like or subscribe. I do daily stock content on this channel, everything from ETFs to stocks. But I appreciate you all for watching, and I hope to catch you next time.